I think there's been a lot of ink on that and a lot of conversations about that, but I think it's the unavoidable implications of two main things: approximately the strikes and their economic impact on the health of the mining industry as a whole, and more distantly the fact that mining in the country hasn't done very well, despite the fact that we've had a commodity boom. And as we see some pressures, although those pressures seems to go up and down according to market prices and the outlook in China and the US, but as we see some pressures on the mineral economy as a whole and demand and prices, we are going to be confronted with the consequences of, in fact, what has been not a very good decade for the mining industry in South Africa.
If we look at the kind of key drivers, apart from policy uncertainty, what would be the other drivers that would drive prices down and productivity down?
Well, obviously, China is the big factor that has accounted for the second mineral boom of the past 40 years. I mean, that has giant impact on demand and giant impact on prices. And in fact, we're doing an analysis now of 40 years of resource trends in Africa. And what we're seeing is enormous correlation between demand from China, the uptake in prices, and the growth of the mineral rent in GDP in Africa. And that's a big factor. So everything that happens in China matters enormously for Africa and for South Africa. But it matters more for Africa than for South Africa, because in fact we haven't seen the kind of Chinese investment in the mineral sector in South Africa that we should have had. So China is not that great of a savior for Africa. I mean, a lot of people think that, well, even if we go on and we kind of nationalize, the Chinese will come and knock at our door. That's not true. I mean, China is very, very focused on getting the right thing at the right price at the right time. And what the crisis in South Africa does is that it brings our ability to do that in question.
If we look at platinum, for example, South Africans are always fond of pointing to the fact that we're sitting at top 80% of the platinum, the world's platinum in South Africa. But if that is the case, Claude, why are we still takers?
Well, because we're not. It's a bit of a silly question, as a matter of fact. I mean, the notion that because you have 80% of mineral resources makes you some sort of a prize giver isn't true. Particularly platinum, it's a very, very tricky market. Platinum has been, there was no platinum industry worth speaking of 30, 40 years ago. It's very much been a construction of the platinum industry itself, of its ability to create markets, to create products for which there is growing demand, but also quite a fragile demand. Prices is very important for platinum industry and for the consumers. And if the price goes too high because the South African government decides to do something which doesn't work well with the market, it's not that we will see an infinite ability of the market to take very high platinum prices. This is not oil, this is not OPEC, you understand? This is not the situation we're in. So if we do the wrong thing, what we might end up doing is damaging the market in the end and effectively sterilizing a resource which will mean nothing. So what's very important about platinum and all commodities for that matter is to understand the dynamics of the market. The reality is that those quasi-monopoly on resources are somewhat optical illusions. If we do the wrong thing, it's not that we're suddenly going to be commandeering an enormous resource which the world is dying to use. The thing is that it will have an impact on price. Too high a price and a whole market for that disappears. The platinum market, it's about 55% is catalytic converters, about 30% or 40% is about is jewelry, and that's very price sensitive. Both of markets are very price sensitive. So we don't have that much of a room for maneuver.
If we take the question around the policy discussions, from where you're sitting, Claude, my understanding from the policy conference is that although there was a bitter contest, I don't see the ruling party going the route of nationalization, in fact wholesale nationalization. What I do see is a change in the existing regime where you will probably sit with a potential increase in the state's equity share. You'd probably look at the change in a royalty regime. What is your reading of what kind of changes, if any, are going to be heralded in come December?
I agree with you. I think what we're looking at is this nationalization debate, which was a bit of a monster for 2 to 3 years, has been somewhat tamed. but it's been tamed at the wrong time in terms of the industry's situation, status in South Africa and the whole global economic environment. So we are certainly, I think, out of the wood in terms of, rabid, dangerous nationalization and the state coming in and nationalizing, mining corporations. That's just not going to happen. I don't think there's any appetite for it. And I think there's no money for it. I mean, the South African state is pulled left, right, and center with all sorts of commitments that it's already struggling to achieve. I think the last thing they want is go and nationalize mines and having to bail them out like they have to do with many parastatals every 6 years. So that's not going to happen. State intervention, indeed, that's going to take place, but to what end? And once again, in a growing industry or a declining industry. If we are going to target nationalization or do targeted nationalization, we're going to do import taxes, or we're going to do royalty taxes, etc. There is nothing intrinsically bad about that. But it's the context and it's the tool that I applied within a particular context and how it's done that matters. And I think in the case of South Africa, it is the wrong policy at the wrong time. The industry has been battered by strikes. I think that particular story hasn't played itself out. We are going to see job losses taking place. That's going to have a political impact. That's going to make communities nervous. That's going to make mining companies nervous. And the whole political environment is going to be tense around that. That has to be managed.
If we talk about that political environment, one of the kind of consequences of the mining industry having to kind of move with the times is, of course, the way in which labor is used, both from a labor brokering point of view and then, of course, also what you do with workers, because we're phasing out the migrant system. Sibiya is on record saying that both those situations cannot remain, the status quo can't remain. What do you think are the potential changes that's going to come there, considering that we had Marikana, and considering the fact that the working conditions of miners in many instances are in fact quite untenable?
They are. And I think the bottom line is that we are going to see a new industry. We are now entering a phase of transition, which is probably going to take several years to play itself out. If we don't change the policy and we don't create a policy framework which allows the mining industry to grow, then we are going to have to shrink the pie. And we're going to have to do that in a politically difficult environment. But at the end of the day, I am sure there is a way forward. But that means having less employees, having more mechanized, more productive, better paid employees, and hopefully a more localized economic impact for what we're doing. We can do this. There is a future out there for the mining industry, which is not in South Africa, which is not negative, and actually can continue to contribute greatly to the economy. But we have to do this very well, and it has to be done in cooperation between all the parties, very maturely and very carefully. Because if we don't do that, then I think we're going to have more trouble going ahead.